Stanford University.
The topic of today's session is investing in early stage emerging technology companies. Context is frontier technology can take a long time to reach the market, and they usually require a substantial amount of capital relative to other startup ideas. We'll look at venture capital's role in developing these new emerging technologies, challenges, implications, trends, limitations to funding these companies. Excited to introduce our three speakers. We've all known each other for about the past 10 years or so, but it's the first time everyone's on a panel together. I'll introduce Baris first. He's a general partner at 8v8 Ventures. He was formerly an investor at Intel Capital, as well as at Google, heading up global strategic business development in the media and entertainment vertical. He joined Google since he was a CFO of a startup that was acquired by Google. And he started his career as a product manager and engineer. Also, we have Julia here today. She's a general partner at Breakout Ventures. Breakout Ventures is a venture fund that was cooked up by Julia and her partners when they first ran Breakout Labs, which is a seed fund within Peter Thiel's foundation. And prior to Breakout Ventures, Julia held a number of operational and investment roles at various life science companies. And finally, we also have Patrick. He was a three-time Olympian swimmer. He currently runs Acario Innovation, which is a venture fund backed by Tokyo Gas. He was also an investor at DBL Partners, also an executive at Samsung, both on their corporate audit team as well as global strategy group. So Baris, Julia, Patrick, thank you all for joining us today. The format for today's panel will provide some definitions, background overview of frontier technology as it relates to venture capital, and then really dive into the investment process, including evaluation and due diligence, as well as post-investment portfolio management. So open it up to the panel. First off, how do you define frontier technology, emerging technology startups compared to other types of early stage companies?
I'll take a first crack at it and also say I think it's pretty fluid. I've always worked in areas of, my whole career has been operating and investing in life sciences. And so you end up being pretty deep in technology, just being in life sciences in general. And we go across, I would say our angle within deep tech is biology and chemistry. So it ends up in gene and cell therapy, a lot of things in bioengineering, and a lot of neuromodulation, neurochemistry, new biomaterials, new biochemicals, biodefense, all that kind of stuff. So what I usually end up looking at as maybe the deep tech part of it is there's some enabling technology outside of the core product that enabled this to be a venture relevant time frame and scale, but it's also why it's so exciting and scalable, right? So it can be everything that's happened in AI and ML and computer vision and automation within tech, everything that's happened in sequencing and genetic engineering within life sciences, looking at the miniaturization of sensors. All of that is enabling me to go deeper in one area of science and get to scale on a huge market. So that's how I look at it.
Very similar to Julia, and I don't look at biotech or healthcare, but mostly on maybe other kind of technologies around automation. And the way we define it, again, everyone has a different way of describing this. And deep tech just by itself, it's a bit weird term. There are people who are playing AI platforms, doing really interesting analytics solutions with very deep technologies at the back end. But the way we describe it is it's first, there's going to be a massive technology risk we're taking. The technology is not putting together building blocks from certain areas. So there's a deep technology risk. That means there's a lot of IP and that kind of diligence that needs to be done. Second, it's a real long path to commercialization just because of the nature of the technology. It's all driven by the technology. It takes a long time to develop, I don't know, an autonomous truck or a satellite or some kind of a semiconductor chip or some kind of quantum computing. Hence, it takes a long time to get to the revenue. That means you need to finance throughout that time. So the combination of those kind of like for us is deep tech, and that could be in many categories. And healthcare is, I guess, by definition, is one of them, like biotech. And I see my focus, and at least our fund's focus has been around space, manufacturing technologies, autonomous trucking, different UAV technologies. And so that's where we see deep tech from that vantage point.
Yeah, I'll add ironically within certain areas of life sciences, because there's always been huge science technical risk. I actually think of a lot of deep tech being faster. I could do it in the beginning of my career, it took 10 years and a year easily. So it's funny how it might offset other risks within the same product.
We don't have, Baris and I don't have clinical trials to go through.
Tell people sometimes, autonomous driving, same issue.
Yeah. So hi, everybody. Thanks again. Just a quick background on Acario to frame my answer, which is going to be very similar to Baris and Julia's. So Akari is the captive corporate venture arm for Tokyo Gas Corp in Tokyo, Japan, Japan's biggest gas utility, and they set up Akari to tap into the startup ecosystem here in the States and get ready for this energy transition. First off, we don't do any fossil fuels. We're trying to get them off the fossil fuels, and it's a long road. But the areas that we're looking at are basically in decarbonization and hydrogen, all the grid 2.0 stuff, which is the distributed renewable network of networks grid. So we're talking industry transformation from central generation hub and spoke to a grid that looks a lot like California's or Texas's, and transportation, electrification, mobility, and coming from an industry where there's not a lot of technology or IT applied, the application of IoT and sensors and all what's called Industry 4.0, thank you, McKinsey, to making industrial operations better. It helps that I'm an electrical engineer, a material scientist by training with degrees from Cal and Stanford. Yes, I did the cross space shuffle. But for us, deep tech, and even at DBL, has been frontier technologies are things that are new, potentially breaking laws of physics, but ultimately things that require a lot of science and then following the science engineering to turn into products, even before you get to market. And an example is battery chemistries and things. One of my former partners said, as a rule of thumb, it takes 10 or so years and $100 million of invested capital to get a battery to market. And unfortunately, at my last firm, we lived through that and many recap rounds in a long time. It's good, but a lot of the innovations that we're looking at, particularly in the energy sector, are immature and require a lot of money to scale so that they can come down in price. And maybe two of the classic examples of that are the cost of wind and solar. Like today, you can get wind and solar for 2 cents or less per kilowatt hour on utility scale contracts and 25 cents per watt or so for PV panels. But 10 years ago, it was easily 10x that. So there's a long learning curve and a lot of time. And when you think about that as an investor, you need to have longer time horizons. And the life cycle of a 10-year fund doesn't always match up with that.
And when you're evaluating these deep tech startups and the science, as Patrick just called it, and you're assessing the technology risks, how do you conduct diligence on the technology, especially when the founder can be the leading expert in the field?
Who wants to start? Are you asking me? There's a number of things you can do. So starting with, and the first thing is to realize that even though there are a lot of smart people in venture, you don't know everything, and not everybody remembers that sometimes. So find really smart people who are in related areas that you can talk to. Ernestine is true. If it's something truly novel, the founder or the initial scientist developer might be the world's expert. But typically for us, they've gone through something like the NREL or ARPA-E programs at the national labs, and there'll be people that we can reference. Sometimes we'll bring in outside experts as well. And you bring up a good point. Technology is not everything though, Ernestine, because you still have to productize that and turn it into a business. We get help and ask smart people that we know. If it's something in healthcare, I'll ask Julia. If it's something in IT or enterprise SaaS, I'll call up Baris and say, hey, who do you know? What do you think about this? And the danger is really that you see so many things, and if you're not sufficiently diligent, you can go chase after a shiny penny that is not what it seems to be.
Yeah. And I'll say something that's the opposite of venture smart, which is we have the coolest job in the world, which is we get to learn for a living and we get to deploy large amounts of money and we get to be on boards and keep on getting smarter while we're doing it. And so I think of my job as, frankly, I just have to stay close to and continue to talk to as many brilliant people a day as I possibly can. And because especially the range of things that we work on, I will never be the world's leading expert on the integration of hematology-driven cell therapies that are using electroporation for in vivo gene therapy. Like there's so many specific niches on the technical side that I think that what you really, we have to really do well is I'll look at something where I'll be looking at a bio aspect of technical risk, like biology. And by the way, biology is way harder than anything with this because it never does what you think it's going to do. And then I will bring an AI specialist in data sets that she can call bullshit on, she can call BS on the, hey, they think that this data set is actually going to be able to drive a scalable product. And so we end up having to, oftentimes, especially in different areas of deep tech, like the technical risk isn't, like there isn't just one silo of risk, right? It's the integration of all of these technologies that is the risk. So sometimes you're looking at does this thing do the thing it says it's going to do? And then sometimes you're like, how I can repeat this like in a lab or in this pilot, but I have no clue how I'm going to make this a cost-effective, scalable solution for a huge Fortune 500 company. So you're looking at both sides of technical risk in that. And oftentimes we hope that the founders are leading experts in the niche that we're exploiting that's at this perfect inflection point, but you have to get input from different angles. And then often the input that we get from different angles, if we're serious about doing that investment, we're also saying, hey, who could we hire to complement this team? Because there's no way this founding team isn't going to have that expert on staff over time.
Yeah, the only thing I'm going to add is I think Julia and Patrick covered the main pieces. It's when you do the diligence on this kind of things, it's really, you have the holistic approach. Just because the science works doesn't mean that we could make money or this company is going to be good. I mean, or the product works, there is a market for it. So it's like really looking at all those components, science, technology, the product, and the market. And you also, Julia and Patrick already mentioned these. The one thing I will add is you go look for a lot of data points. And that's, as a venture capitalist, you're not the smartest in the room. You have this delusion of knowledge, but it's you have an amazing network, right? That's our biggest advantage. We got to the right people quickly to go through this, and that's our advantage. Other than that, I don't know anything about the synthetic aperture radar. I need to go to someone who spent 10 years on it. And so that's one. The second thing I will say, and you're going to take all this feedback with a grain of salt, right? It's the tendency, at least in my career so far, I see a lot of experts being way more pessimistic and this whole NIH type attitude towards some of the technologies that they haven't worked on. So you gotta be a bit more, I guess, cautious when you're getting those kind of feedback. Like this typical will be, oh, this will never work. They can't make it work. Oh, even if it works, people won't buy it. And so that's what I see from the technical people. And on the product side, I see a lot more optimism as a potential buyer. When you do the market diligence, people like, oh yeah, if they have it, we'll buy it. I don't know who said that, but for an unbuilt product, there is an infinite demand. Right? Everyone says they will buy it because stated behavior versus observed behavior. They will say they will buy it when you have it. Very few people will write the check. So you got to be very cautious in getting those feedback from both sides. So the technical people who are very usually pessimistic, you got to be careful with the product side. That optimism may not turn into revenue. So you've got to be careful how you read that feedback from the market side.
I'll add one example to Baris' comment on pessimism. So Ernestine intro, I built and still run a portfolio of 50 investments for Peter Thiel, all in deep tech, all this sort of cutting edge of science. All of those were pre-seed or seed deals. So like really early stage, really crazy stuff. I actually did like a bunch of, these guys have seen some of it, like maybe it went a little too far sometimes. And we actually tried to do a peer, because we were doing it years ago before it was as competitive too. We actually tried to do peer review to give some credibility to the scientific diligence. And we did it for all 50 companies. So we would invite, because that's our network, we would bring in academics and different sort of level of peer review as if this were like a Nature paper or whatever else. And it's interesting how pessimistic those folks are. Because also remember, a lot of specialists have spent the last decade working on something else. And then if you're showing them something that in theory could be better, they're usually going to hate it.
Yeah, that happens all the time.
So related to the diligence process, assume the science works, it's amazing. How do you then assess the regulatory hurdles needed to get to market to actually generate that revenue? For example, in biopharma, Julia, you're looking at FDA trials, or for autonomous vehicles, blockchain, who knows when that'll be fully regulated. How do you think about those somewhat unpredictable regulatory hurdles, and how does that affect your investment decision?
I'll go with the autonomous trucking one, which we've done in 2018. And I spent some time with the regulatory folks try to understand what will happen in terms of licenses for autonomous trucking across the United States. It's a very complicated issue. So there's science piece we just talked, and then the regulatory piece, at least for autonomous trucking, was almost as complicated as the science part, where every state has different rules for different type of autonomy. And for testing and for live, they have different expectations. The timelines are different. We talked to a number of folks from the regulatory side. We talked to a number of lawyers, try to understand how to interpret all this stuff. But at the end of the day, you make a call based on the data that we have and have some understanding of what the downside, what will be our outcome as a fund in that kind of a downside scenario. And we were comfortable with that situation and that we went ahead. But there is enough ambiguity in that regulatory landscape that it could easily paralyze you not to do the investment. So you, at the end of the day, this is venture capital. We take risk. And when we take the risk, there's some calculated risk behind it, which is, okay, if California never accepts it, are there enough routes across the United States that where this company can get to X $1 million revenue? So that's like the thinking, how we go through that. And we were comfortable with the fact that there are enough states out there that are so far ahead in terms of regulatory environment that we will be able to get these trucks on the road in the near future.
One heuristic, and we don't always go by heuristics, but one thing we've learned is like try not to invest in anything that requires regulation to make it work, because you're going to be in for a hard, long ride. If you can find products that people are willing to buy that don't depend on that, that's great. That said, in the energy space where I live today, the market economics are totally driven by regulation and ability to access markets. At DBL, we spent a lot of time with Solar City talking to different state legislatures about allowing net metering and not letting utilities shut it down so that there would be market development for Solar City. A time in front of CPUC and California Energy Commission trying to get different regulations set up to enable business models for distributed energy resources and energy services. And today we look at a lot of these immature carbon capture technologies, and people are saying, well, you need a carbon tax of about $100 a ton plus to make it economic. Well, that's not a good thing to be going into. So on the one hand, Baris says you have to make a choice. Can this technology capture a big market, create good profits, part of which is driven by regulation, and drive the fund returns that we're all looking for and that we're, as GPLP investors, fiduciary responsible to our LPs for, getting a return 3 to 5x the fund. So regulation ends up being a lot about market access and timing and economics. And it's a risk, but in many cases it's a known risk, but it's going to change. Like with Julia's dealing with the FDA, and there's a process for filing your data and all, and it's a long one. But if you know how to go through it and you have good relationships with the examiners, you can get through that.
I think it's more fun on panels when people disagree. So I'll say, I disagree. No, I actually think it be a strategic advantage, and especially in some of the areas that I work in. So and not everything that I do is farming. It's just, it's like the most easy business model / playbook that everyone knows, right? But no one can go once you get into the clinic. So regulatory advantage. So if you're thinking about something that's a gene or cell therapy, if you have the advantage of having a better insight on the clinical, preclinical, regulatory path early, then you actually can block out competitors. You can grab subsets of patient populations that will outperform. You can grab those patients earlier in rare diseases. Like there's all sorts of ways that you can use that advantage. And I have actually, you guys, everyone here knows Jenny Rupp, a co-investor of mine. One of her lines is, give me the FDA over a consumer any day. Right? Like consumers are fickle, all that market cap's gone if they turn on you. The FDA doesn't turn on you in the same way. It's a little bit more known. And then on the other side of that, the thing that I probably learned in my career is now that I'm like in those conversations a little bit more and on the boards of these companies that are doing cutting edge technologies, and I can really see the FDA conversations playing out more intimately. It isn't always a known process. You can influence the FDA, right? Like you can get ahead of it. You can request pre-IND meetings. You can have people advocating for you in rare diseases and in certain areas. Like that's the difference between if you just take the playbook, it's 4 years. And if you push, you can do it in 2.5 years or 2 years. So I think it can actually be an advantage sometimes to get you ahead of competitors.
I mean, one thing we haven't talked about is the patent side, like as almost as powerful as the regulatory side. Like I agree with you about once you get the approval, it becomes a big barrier of entry to others. And the patent is similar, right? In certain ways, especially with this deep tech investments, patent portfolio is for us, the patent diligence, but for the founder, the patent portfolio becomes a very important competitive advantage. There are companies who create a patent minefield for anyone to walk through to not get close to their core product and technology. So it's a smart way and also deeply defensible way of differentiating in the market.
Question from the class. Do you think the rise of SPACs will influence the funding of early stage deep tech companies? Putting just some context around that, SPAC is something that started to emerge over the last few months, which stands for Special Purpose Acquisition Company. It's a way for companies to go public without going through the traditional IPO process through these blank check shell corporations. It really propelled, for instance, the electric car market going public. So question for the panel, do you think the rise of SPACs will influence the funding of early stage deep tech companies?
Influence funding versus good idea are two very different answers. I think they're a horrible idea for most deep tech companies because the thing that no one is doing the math on is being like going public through SPAC or raising through SPAC. You still have to go public. And I'm sorry if anyone else really enjoyed reading the Quantum Scope SPAC like prospectus. That was horrific. There are so many years until revenue. So you don't want to be a public company with that outlook. So I just feel like some of those are some of them will be great. I'm sure of it. But I definitely feel like that's going to blow up for some folks because you don't have the metrics to actually be running a public company.
And Julia, you still have to do SOX compliance. You have all the costs associated with that. For some firms, let's say it this way, there's popularity and there's an IPO window up in the market and people are tapping public markets. For some firms, it allows them to get the capital they couldn't raise in the private markets to actually execute on the plan. And maybe at the end of that time, they will have achieved it. And it was a way for them to do that, particularly if you have like to build expensive infrastructure like EV charging stations or something. For a lot of companies that we look at, a lot of us scratch our heads and okay, an EV OEM is getting an average $2 billion post-money valuation. And some of these companies have no route to product, no route to profits, let alone and revenues, let alone profits. And how long are they going to last? When they're not going to be able to tap into it again if they can't execute. And for others, like a charge point, that makes sense. You've gone public, you've tapped public markets, you get additional growth capital without necessarily having to go through the roadshow. And one thing in SPACs that's interesting is you can talk about forward-looking plans, which you can't do on an SEC roadshow, typically for an IPO. So it's a mixed bag. It's just another tool that people are taking advantage of. And it has to make sense, like any other financing decision.
Yeah, but if you wouldn't have otherwise considered going public, then you probably shouldn't be going through. Yeah. Comparing like, is this faster, cheaper, easier way to go public? If not, I'll go public. But if you didn't have that option, you probably shouldn't be looking at SPAC.
Yeah. One impact of that, I guess, is going to increase the appetite for early stage investors to get into the market, which is positive for deep tech, because what they're going to see is, as Julia and Patrick mentioned, the number of companies who went public through that path, SPAC. And so it's being decrease the time to exit for some of the early stage investors and put some at least numbers on the scoreboard in terms of comparables. And now seed stage investor will be more willing to invest in those kind of companies because there is a path. This will continue until, to Julia's point, it will crash. Right? Because at the end, you are becoming a public company that you need to deliver on a quarterly basis and revenues. And this nature of these businesses, when they are going public, if you look at some of them, are all 24, 25, like 4-year ahead revenue multiples. So that is today's market. If there's any contraction in the market, that's not going to happen. So they need to deliver revenue, and then there's a huge correction for kind of companies. So both public investors and probably the founding team will unfortunately not benefit from that. But I can see a time window where it works out well for deep tech founders, for early stage investors, as liquidity continues.
Yeah, I'll add one more thing, Baris, which is from the perspective of the company, it's actually a decent thing because they end up keeping most of the control in the merged entity, the original company. As an investor, buyer beware, and sure, interest rates are zero, but they won't be forever. And this party will also crash at some point and those that aren't really ready to be public companies will go down.
Yeah, you could be also picked up as GameStop. I'm not sure if you are following what's going on with GameStop, with some Reddit crowd just piling on a stock and just skyrocketing because of the short interest. What if you get caught into something like that? Yes, you have control, but you're public now. Anyone can do any kind of stuff through either what GameStop is going through or some like activist investor. It's a totally different game once you're public. I don't have that kind of expertise on the public markets, but today it's very attractive because of the liquidity. And these companies need a lot of capital to get to where they want to go. And that money is coming cheap. If that continues, yeah, it's fantastic for deep tech.
Another question from the class, are we in a bubble now? Obviously, we're all seeing very high valuations for companies that don't have revenue. Sometimes they don't even have a product. Are we in a bubble?
I think actually all three of us were investing in the last downturn. So
I haven't seen launch parties with the.
I bet you're in a bubble when your only customers are other venture-backed companies. That's a problem. I'm not sitting here trying to be an economist. I can tell you what other investors say, what our LPs say, which are mostly billionaires and some including Peter, and then some multi-billion institutions. And this isn't my insight, but interest rates at zero, where else are you going to put your money? It just keeps going to risk. And that shifts over time with interest rates. But I actually, unlike I think when I was investing in life sciences in the last downturn, and that was long time period, lots of capital, risk, like you had everything working against you. And like I said, the ability to pull in some things maybe might help deep tech and more technical companies a little bit better and to weather that storm. And I think there's definitely more permanent capital in some of these spaces, just the way that there's more seed funds, there's more corporate, there's more family office activity, there's all sorts of different ways to finance a company that would survive a little bit better than last time, I think.
I agree with Julia. It's no one knows, but the zero interest rate environment definitely brings a lot of liquidity and cash. And bubbles are always in hindsight. In the hindsight, it's very obvious. But now, yes, things are extremely inflated. Like you look at the multiples, you look at what's going on. My personal experience was, I think it was 2012, was it 11? I can't remember. This was right after the 2009 crash. I met DeepMind folks, and they were raising their seed round at 40 pre. At that time, that was unseen. And that was Peter, who I think led the pre-seed or something like that, because Dennis was a chess prodigy. So they apparently met during a chess tournament. So it looked like, oh, my, this is crazy. This is bubble. This company will never go anywhere. And DeepMind was a fantastic investment. It could have been even a bigger company if Google didn't acquire them, I think. But so when I see the companies now, and especially for founders, is it bubble or not? Why do I care as a founder, right? There's capital. I just need to if I have a great idea and there's liquidity, if I act, responsibly and raise enough and just execute, it really doesn't matter. It's a perfect time to raise. You just need to have the discipline to be able to execute to wherever you want to go with the capital available. And for an investor, it's way harder. For us, the entry price, like the price points are increasing. So you're like pushing out where we can make money. And if that comes down, we don't make money. For founders, it's a little bit different. So for founders, the biggest problem is the inflated wage inflation going on in the market.
Yeah. If you lead with fundamentals, though, as Baris is saying, you focus on your milestones being what are the value inflection points in any market, not just in a hot market, then usually you figure it out.
I think
is there any one of us like regretting to invest in a great founder, regardless of downturn or a great no? Right?
And Baris, you bring up a good point, though. You have to be continuously disciplined in your approach. And Baris brings up another good point. Like I started my career as, okay, it's all about the market. But over the last 10 years, I've realized it's really about the team. You need to be in a market that matters. But we see so many companies, and we'll often see, we're looking at this space where you looked at one company, hey, there's 15 others that are doing the same idea. Who's going to win? One could argue that SoftBank distorted that a little bit by dumping a bunch of capital into certain companies. But ultimately, it's the really great founders and teams that find a way to keep pivoting or keep financing and keep funding a company long beyond the date anyone thought it should have died. And then they win. And so we try to find the best teams who can execute in big markets. At least that's what I've been trying to do.
Mm-hmm. Patrick, I'm glad you're talking about market and team, since another question from the class is, how do you think about valuations for pre-revenue deep tech companies? Do you ever attempt to make quantitative estimates of the total addressable market and work backwards? Or are you making more gut-based decisions on the founders, the team, and the tech?
How pre-revenue and pre-product are we talking about? Is it like two PhD students in a lab at Stanford? Oh, no, it's tough. Valuation is not a science, really. And it's also in market, because remember that you're often competing with people to be A, leading, or B, even in the syndicate and get an allocation, even if you have pro rata rights as a prior investor. So at that early stage of like early company formation, early product, it's the hope and the dream. The founders are selling the hope and the dream. This is a giant market. I'm uniquely suited to tackle this, and I've identified a problem that if everything works, it could be pretty lucrative and we could capture a large part of it. And we have a product and we've tested a little bit, and a lot is still out of your control. You could have everything go perfectly, and then 2008 comes along and the market crashes, or regulations change and like something that was allowed is no longer allowed and your business model evaporates. I don't have a good answer, Julia, other than finding really people who are pattern recognition is identified as, this is a good founder who can execute in an interesting market, and then trust them and go on that journey with them. But assigning a value and doing market, what if the market doesn't exist yet? It's enabled by this product or service. How do you value that?
Yeah, I'll give a couple thoughts. So one, I've invested, like, started off in public, have started companies, have done later stage, like in my private life, I actually have quite a bit in late stage fintech and like all this other stuff. And so the joke is like, the earlier stage you go, you don't have to, like, the worst you can be at math, or maybe like the worst you can be at Excel or whatever, right? Like, you know, nobody in a seed fund knows how to do a macro. Like, they don't even know how to use anything beyond Google Sheet. Like, it's about how much money can I put in and how much ownership can I have? And I think this is worth a lot, right? Like, it's super simple. And so when you talk about like how to value something, which obviously we have to do, you think a lot about these ownership things. And so I probably should say, like, we do a lot. So we have a group of, I don't know if we're called scouts, fellows. We always have postdocs that kind of work on with us part-time, and a lot of PhD founders. And so I feel the need to always like explain how venture works. And so I talk about, I think of 6 major buckets of risk make up your discount rate against a really huge market. And so can you identify that really big market? I think this would be like $1 billion, something, whatever. And then what else? Technology risk, market risk, commercial risk, financing risk, execution or team risk, and exit risk. I think of those as just like contributing to the discount rate of whatever that valuation is. And it's really high at the beginning. But then there's some really interesting stuff to play with that same idea of like, how do you value something? If anyone knows Arch Ventures, it's a big biotech investor, and also some areas of industrial as well. But like, they regularly do these new codes with 800 million to $1 billion raised, and like essentially all they've done, and it was like, how do they do that? How do they price it? Everything else. They just did all but the technical risk. They took care of everything. We're not going to worry about money. We're not going to worry about team. We're going to go after huge markets. Like, and then all of that focuses on technical risk. So it's this interesting mix of how many risks are you willing to take on too. And team ends up being the one that raises that valuation amount.
Another question from the class is, how do you think about timing it right when it comes to investing in deep tech? A lot of the failed investments in deep tech are often due to investing too early before the market was ready to adopt, rather than investing in the wrong technology. I'll add a follow-up question as well to that. And then after you've made the investment, if you realize that you've invested it too early, do you keep pouring in follow-on capital to support the company? Or at what point do you know that you need to wind down?
It's a lot. The one way to mitigate against that, and at least what we think we are doing, is the voice of the customer, right? If you get the voice of the customer, talk to enough potential customers with the caveat that they may change direction, they may change their decision and all. But if you talk enough of them, you can get a sense of what the timeline to commercialization will be. So if there's a product today, are there customers willing to buy today? And what are the hurdles that the company needs to go through to be able to sell? At what price points and that kind of stuff. You could really diligence that by understanding what the company is doing today to fix that problem, or if this is a groundbreaking technology. Yeah, I don't know the healthcare part, but at least in the space, like we have a satellite company, which has a proprietary data set for weather. And just digging, there are very few companies who has that kind of technology, and they have very unique approach to do it. But when you go do the diligence and talk to many different verticals and customers, you can see if the accuracy is at the level that the company think they could get to. There's enough demand. So that kind of mitigates that problem of are we early or not. But if you are early, if you ever do that, which we haven't done yet, that's the risk reward profile of the overall fund. Like how long are we willing to go through that path? Because there's some companies will take maybe 10 years, 12, 13 years to get there. And SpaceX was, kudos to Founders Fund. A friend of ours, I think 4 of ours, is Justin Fishner. I remember him telling me SpaceX deal in 2009 because they were running out of money. And I didn't understand, is he joking or if it's real? Like, are you really investing in rockets? At that time, no one was doing it. And the whole world was collapsing and he was asking for capital for rockets. And they stuck with them for years with going through a lot of tough times. And now it's obvious. But at that time, it wasn't. And their fund has that kind of a risk reward profile to go through that J curve. And with our fund, which is a smaller fund, $180 million fund, we don't have that kind of a risk profile to go through 10 years of technology development. So we will try not to do those deals because we're not the right fit for those kind of deals. But there's some funds who have longer horizon with bigger capital that could take on those risks.
Yeah, timing is tough. In the energy space, it's longer, which is why you see things like Breakthrough Energy Ventures have longer terms and more committed capital and a lot of family offices coming in to go after this market opportunity. A 10-year fund with 2 extensions to 12 or 14 years. If you get in super early, and remember that quote, 10 years to get a battery to market, you shouldn't take those investments. And timing is really hard. So, I was around in the .com boom, and I remember as a student actually at the GSB, and I remember pets.com. And in fact, I've got through an investment in Real, got to know Julie Wainwright, who was the president, really well. And Julie was like, I know everything there is to go wrong. And today, my wife regularly orders from Chewy and Amazon for cat food for our cats. So 20 years later, the market is there. It's hard to tell. And part of our job is to look around the corner to the future and have conviction and take a reasoned bet, but it doesn't always work out. Market development can be driven by a lot of different things. And then your second question, Ernestine, when do you cut the cord? That's one of the toughest decisions to have around a partnership table, because you have X amount of funds and your duty is to return capital to your investors. And you're better off often piling in money to your winners to, if it's me a 10X, double down on Tesla, double down on SpaceX, double down on whatever it is, because you need to return funds. And there's ones that are dogs that, like, lemons ripen early is a phrase you often hear in venture, like things that'll die early, and the ones in the middle. But if we only do another round, it will get to this milestone, which will unlock this. And it's a tough call to do. And it can cause a lot of spirited discussion, I'll say, in your part where you should allocate things.
Yeah, I'll just add what Baris said about the customers. And it's like the timing you don't want to get wrong is the partner, customer, potential acquirer. Then you need to buy yourself some wiggle room for everything that will go wrong on the timeline and technical. I have my own examples of invested in a B cell therapy or new modality in cell therapy too early. And the farmer's head just wasn't there. But like now, it's a Series B, it's raised a lot of money, I'm on the board, and it's comp 6 months from now, we're $1 billion. Now we're there. So I've gotten better at being like, okay, clearly I overshot some of that. And pharma typically knows, most corporates know where they want their top line, where they want their investment to be 5 years, 10 years from now. Like, just make sure you're listening to that and what feels risky to them versus what feels a risk they're going to have to take to be competitive. Like, if I don't invest in the EV space, but I'm sure everyone's saying to themselves, we have to be in the EV space, right? In what you are doing, Patrick. And in my space, that's the equivalent of gene and cell therapy. Everyone knows in 2025, revenue is going away from top line and they need to replace it with the next gen therapies.
I think you can count, just one last comment, Ernestine, I think you can pretty much count though that whatever your investment memo says, it probably is going to take more time and more capital than you initially thought to hit certain capital for certain milestones.
Definitely. So portfolio management, you've made the investment. Let's talk about managing and shepherding that investment. First question, how do you measure milestones and success metrics for these deep tech companies over time?
For us, is mainly driven by key commercial milestones. We are very commercial focused in that sense. Either LOIs, letter of intent, or memorandum of understanding from the customers that this is going to be deployed, or some form of contract, forward-looking contract. When the product is ready, they will buy the X amount. So those kind of commercial traction is really critical. And maybe the one other area with the product will be is really the pilots, trying to understand these are non-commercial, potentially commercial, but at the beginning it's more about testing the product and making sure that it meets the customer demand, customer requirements. So we focus on those two a lot.
Acario, I don't describe Series C through C. What I tell people is that we're looking for post-product or product development done, so a lot of the technical risk is rung out, and starting early commercial revenue, very much like Baris. And I'll just say one more thing before that. Typically, but like the last company we invested in was Thanksgiving, a company called Halo, microgrid technology company. But I've been following that for like 4 years already. I met the co-founder, technical co-founder, when he was a grad student at MIT and presented to the National Renewable Energy Labs. Like, I have this great idea for how to do microgrids. Okay. But it took a while. A lot of these, you have to meet them early and follow them for a while and see which ones end up. And then at the time of productization is where we get in.
Board observer on all of my companies. And so do a lot of the like planning out milestones with CEOs. And even I need to be able to, as we're investing, like there's a million different ways people draw this. I think of each round of financing as like you're running a set of experiments and you have some outcome there that you're tying to a value inflection point. And so you think of have everyone draw out it like when you start a company, when you're raising money, and it's going to keep on changing. But that whole idea of here's the first group of experiments I need to run to have a value inflection point. How much money does that cost? Then add 9 months, right? Where can I get non-dilutive financing? Our companies use a ton of grant money, BARDA, NIH, SBIRs, DOE, like everything's go across a bunch of different areas. And then really just always be refining that thesis of what are the value inflection points, the experiments you're running and the outcomes that you can then raise on. And it's a new set of risks. The thing that always screws, they finance to nowhere, right? They're in the middle of a super expensive part of a development plan or something like that. And then they go and try and raise money, and they've really proven no more than they did the last time they tried to raise money.
And stage and strategy also, depending on what sector you're in, there's certain rules of thumb for how long it takes to get a company to cash flow positive. And I tend to ask when people are in front of us fundraising, okay, this is nice, but what are your total capital formation needs to cash flow break even? And if they're, say, an enterprise SaaS company like Salesforce took around $70 million or so. If they're saying they can do it on 10 million to get to that kind of a scale of Salesforce in 10 years in, probably not, unless something really crazy has changed. And so you just learn these things over time. And also you talk to your really smart friends like Ernestine, Baris, and Julia to figure out what it is. But always, whenever you're investing in a company, you do want to be aware of what is it going to take to get this to. Is it a $50 million exercise with multiple people? Is it a $10 million exercise to get to that point?
I feel like we should just stop talking and say, bottom line, collect people who are really good friends who are much smarter than you. That's pretty much the goal to success. Or the right.
Yeah. surround yourself with good, smart people.
Yeah.
Are there typical exit patterns that you've noticed for these deep tech companies that might differ from other companies, or what would you guys consider as successful outcomes for these deep tech investments you guys are making?
I mean, specs are going to be one big angle for non-healthcare, I guess. Like healthcare is different, but it's especially in some of these companies who have long-term revenue horizon. Specs seems to have a different risk reward profile than some of the later stage venture capitalists. And also time pressure. Again, the specs are being raised in an 18, 24 months of time fuse. So they need to deploy the capital. I think they raise as much as their $70 or $80 billion raise last year, which is as big as US venture capital market. And this year they are on a $200+ billion run rate if they continue raising at that pace. So it's another $200 billion looking for acquisitions. And there are many companies to acquire at that stages. They're going earlier and earlier. And yeah, they're buying companies which have a revenue. So my take is SPAC is going to be a big exit avenue for the deep tech for the near term. And I don't know, like maybe healthcare, Julia can tell more about, because it's been an established market with exits.
Yeah, and I think the interesting thing is I feel like I've talked as if all I do is therapeutics because it's just so much easier from a playbook, but it's not all I do. And even in healthcare, I actually do a lot of robotics and automation for, people-free drug discovery. Like we're probably gonna have to take that public. I don't really want to, I'm scared of that, right? That's not ideal. And so we're still writing the playbook in a lot of those. And I think in areas of, so biotech, it's easy, right? The milestones are what's going public when, stuff is going public preclinically. I barely have to raise a Series B for some of those. A lot of what I do in more industrial biotech and SynBio and other areas like that, you have the traditional, you end up with some of the same issues from a liquidity and exit point of view that you have in traditional markets. So there's some awesome case studies about materials investing and why it's like an absolutely horrible idea. And yet all of us are still doing it because now it's deep tech, right? And then you're like, we're going to do this totally differently. And then you end up, on the board of one of these companies and you're scaling it and you're like, ooh, we're going to have these same issues of like, this customer that we thought maybe could acquire the whole thing. Now we've got this whole business line and this other thing they have no interest in. And are we going to have to split up the company? Do we have to take this public now? There's definitely some playbooks that are still being written in some of those spaces.
Yeah. I laughed when Julia was talking about materials investing. Most of the companies you'll invest in will not go public. They'll go public if they're creating or segmenting a new market. And if I think back to my RD Build time, like the real, right? Online, authenticated, luxury consignment. Mapbox is probably going to go public eventually because it's creating a new mapping and geolocation platform. Other companies in industrial, the supply chains and the buying and the distribution channels are so set up that you're more likely to be bought up, have your startup bought up by one of those companies who's trying to fill in a hole or gap in its whole solution for its customer base. Now, every so often something comes along to make everything new. So this EV transition means that tier ones are no longer the only ones who can sell directly to OEMs. Startups can now sell directly to OEMs like Luminar to Volvo in LiDAR. It really depends, but I would say most of the industrial type investments and tech investments are going to be an M&A by a bigger industrial concern who already has distribution and reach, unless, like in EVs, the market, the whole stack is being blown up. And then you have room for new things to happen.
I also say this probably is a good problem to have, but it's a problem I have right now that is a big problem in terms of liquidity is if you are luckily enough to have something go public early, but then you're sitting there and you're like, it's been in 10x, but I think it's 10x more. And crap, it went public too early. So now I actually have to make a decision on it and possibly piss everybody off because I just left a bunch of money on the table. So like things going public too early can be a problem too.
Your LPs will always be mad at you for that. Unless some people have told us like, not at this fund, but we don't pay you to be public market investors. And especially when you have institutionals like pension funds and others that have to provide dividends or things there. They want the liquidity because they have to turn around and sell it within a few days or 6 months. So.
A different discussion, distributed 50% at an 8x held on to the balance of the 50% for the trial readout. And so no one can bug me.
The final question for the panel, I'll let you each answer one of two questions and limit your response to 1 minute each. Both are questions from the class. So question one, option one is, what do you think is the next ecosystem that will become deep tech? And option two for answering is, if you had to start a company right now, which industry and type of company would you make? So answer one of two questions. I'll let Julia start.
Cheers. So next ecosystem for deep tech, what's the city to move to for deep tech essentially?
Yeah.
And which industry would you build something in?
It's also the $1 billion question right here.
Yeah, I actually am going to be a bit contrarian on the ecosystem one and say, don't move to Austin. Don't move to Miami. I think in deep tech, you want to, again, it goes back to this ecosystem work and great books written on ecosystem development, where it's go where there's talent, there's corporates, there's PhDs, there's all of those inputs. You may not want to grow there anymore. So a lot of our companies that we're starting so my investments, Cambridge, Seattle, San Francisco, I'm talking about like Bay Area, like the ones that have done the best, New York, Minneapolis, because there's a lot of neuromodulation in Minneapolis. But you go where your people are and maybe you scale somewhere else, but you have some core there. So I'm actually not going to try and call a new market. I'm going to say there's a reason why some markets are the markets they are.
I guess the first one was the which vertical, the second one was which city ecosystem, right? Quickly, the first one I will say, I guess the ignorance is bliss. So it's hard for me to pick the areas that I know a little about. So the ones that I don't know much, which looks very exciting and a lot of things are happening, is one obviously is the quantum computing, and the second is the computational biology. A lot of interesting stuff happening in there. But I don't know anything in both, so it's easier to call them out. The rest, like autonomy, space, and all that stuff, we have a lot of scars on our backs. Yeah, the ecosystem-wise, I agree with Julia. You got to build companies where you can have the right type of folks around you, and it's really hard to build it everywhere. I invest, so my investments are in Pittsburgh, Denver, LA, Oregon, and Portland. One of the biggest challenges is hiring. It's great, like with the core 6 to 10 people, any of those locations will be fine. But then once you started to scale, hiring is extremely important.
Yeah.
Yeah.
Which, by the way, I should say the caveat is changing a little bit in COVID. We're working on a Grail spin out, which just sold to Illumina. And like now the team can be anywhere. So it's not really Bay Area, it's actually Canada based. But so maybe that's going to be a little bit different now.
Yeah, I understood the questions a little different, but if I take Baris and Julia's point, go where the best people are, because you create the best conditions for an intentional and unintentional serendipity and have the resources to build interesting companies and have interesting things happen. Thankfully, there are types of work that can be done remotely and in other places, and I'm glad to see many more sort of centers of excellence popping up all over the world and across the US, because we need that. In terms of, when you said ecosystem, I took that to mean, what sector do you want to be in next? And for better or for worse, I've made my choice for the next 10 years. We have 10 years I don't want to sound too like socially impact oriented, but we have 10 years not to cook the planet and fix a lot of things. If you think about, pick a survey, but we have 1,000 gigawatts of generation here in the US, and to get to a net zero grid, you need somewhere between, in the next 20 years, we need somewhere between 3,000 or 4,000 gigawatts, so a tripling of that, multi-trillion dollars of spend. And so that's a massive market. The flip side is it's been hard to make money in energy and renewables and all that other things, but it's a massive market, and we have to fix the carbon load problem in the world before, because my son's going to be off to college in 10 years, and he's 9 now, and I didn't know what we're going to be leaving him. So the trick is finding there's got to be something in there, right? If there's that much money moving in. And there's a lot of deep tech that needs to be applied and scaled up, not so much developed, but really scaled.
Absolutely. Big challenges we need to solve.